All right, let's dive in. Today, we're going to put on our detective hats and solve one of the biggest, most common mysteries in the world of finance, the case of the unbalanced books. We're going to take all the guesswork out of finding and fixing accounting errors, basically turning you into a financial sleuth. So, let's grab our magnifying glass and get this investigation started.
You know that moment, right? That heart-stopping feeling for anyone who's ever looked at a ledger? You've added everything up, you've checked it twice, but the two columns, they just don't match. That little bit of panic, well, that's where our case begins. The numbers are screaming that something is wrong, and it's our job to figure out what, where, and exactly how to fix it.
So, here's our game plan. First, we'll get a handle on the mystery itself. Then, we're going to meet our 4 usual suspects, the main types of errors you'll run into. After that, we'll get into the real detective work, finding the clues. And finally, we'll solve the case by making the right corrections. Okay, let's get to it.
Every great mystery needs a good setup, right? And our story kicks off the moment we discover a problem. A clear sign that things in the financial records are just not adding up. First things first, what are we actually looking for? An accounting error is, and this is super important, an unintentional mistake. We are not talking about fraud or anything like that. We're talking about simple human errors, a little math mistake, maybe misreading something, or just an oversight. Look, they happen to absolutely everyone. The key is just knowing how to hunt them down.
So the trial balance, this is your first crime scene. It's a really simple but powerful tool. You just list out all your account balances, and the golden rule is that total debits must equal total credits, always. When they don't, that's your alarm bell. It's a blaring signal that an error has snuck into the accounting process somewhere.
Okay, so we know a crime has been committed against our books. Now it's time to meet the potential culprits. In the world of accounting, there are 4 main types of errors, and you can think of them as our usual suspects.
First up, we've got the imposter, also known as an error of principle. This is when you do the mechanics right, a debit here or a credit there, but you completely break an accounting rule. For example, say you buy a new computer, which is an asset, but you accidentally record it as a daily office supply expense. Now here's the really sneaky part. Because the debit and credit amounts still match, your trial balance will look perfectly fine. It balances.
Next on the list is the vanishing act, or an error of omission. And this one is exactly what it sounds like. A transaction just disappears. It was never recorded. If you completely forget to record a sale, for instance, then both the debit and the credit are missing. So what happens? Your trial balance still mysteriously balances. It's only when you partially forget an entry that the alarm bells will go off.
Suspect number 3 is the mix-up, the error of commission. Now, this is probably one of the most common reasons your trial balance will be out of whack. It's just a clerical error. You have the right idea, the right principle, but you messed up the execution. Maybe you posted a debit to the credit side by mistake. You typed in $51 instead of $15, or you put the money in John Smith's account instead of Jane Smith's.
And last but not least, we have the perfect crime, the compensating error. This is just the unluckiest kind of luck you can have. It's when you make 2 or more totally separate, unrelated mistakes that just so happen to cancel each other out perfectly. You might overstate your sales by $100, but then you also overstate your rent expense by $100. The final numbers look right, but the details are a mess.
So here's the real challenge for us detectives. Take a look at this. Notice that 3 of our 4 suspects, principal, a complete omission, and compensating errors, will not actually make your trial balance disagree. This is huge. It means a balanced trial balance is a good sign, sure, but it is not a guarantee that everything is correct. The most common culprit when your books really won't balance, it's that prime suspect, the error of commission.
Okay, we've identified our suspects. Now it's time to gather the evidence. A good detective never just searches randomly. No, they follow a systematic checklist to track down the clues.
Every detective has a procedure, so let's walk through ours. Step 1, and this is the simplest one, just re-add the trial balance columns. You'd be surprised how often a simple math mistake is the real culprit. Step 2, make sure nothing obvious is missing. Did you remember to include your final cash and bank balances? Step 3 is a classic trick. Look for an entry that exactly matches the difference. Now, if you find an amount that's half the difference, ding, 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 you've probably posted something on the wrong side, a debit that should have been a credit. After that, the search gets deeper. You'll move on to rebalancing individual accounts, then checking the original math in all your journals, and finally comparing balances to last month or last year. A sudden massive jump in an account is a major red flag.
Finding the error, well, that's half the battle. Now we have to actually fix it, and fix it the right way.
This is what we call the art of rectification, and how you do it depends completely on when you catch the bad guy.
Basically, there are three main stages for finding an error. And trust me, the earlier you find it, the easier the fix. Stage 1 is when you're still in the middle of your daily bookkeeping. Stage 2 is when you've hit that wall and your trial balance just won't agree. And Stage 3, that's when you find a mistake from a previous year and those books are already closed.
So, if you catch an error early, back in stage 1, the fix is often beautifully simple. Let's say you added up your sales journal and it came up $200 short. No problem. You can just go right into the sales ledger account and add a correcting line with a little note explaining what happened. That's it. No complicated journal entries needed. Easy.
But what about stage 2, when that trial balance is already off? This is where we bring in a special tool, the suspense account. You can think of it like a temporary holding cell for criminals. You park the difference from your trial balance in this account so you can force the books to balance. This lets you get on with preparing reports while you continue your investigation on the side.
Let's see how it works. Say your sales book total is $100 short. That means the credit side of your trial balance is also $100 short. So to make it balance for now, you just create a temporary credit of $100 in the suspense account. Poof! The books are balanced, but we both know there's still a mystery that needs to be solved.
Once you find the error, that short total in the sales account, you make a formal rectifying journal entry. You credit the sales account by $100 to fix the original mistake. And what do you debit? You got it, the suspense account. This single entry fixes the error and clears out the suspense account, bringing its balance back to zero. Case closed.
Now for those tricky stage 3 errors, the ones you find from a period that's already closed, we need a totally different tool. You can't just go back and change last year's expense accounts. That would be a mess. Instead, you use a profit and loss adjustment account. This makes sure the correction for last year's mistake doesn't accidentally screw up your profit calculation for this year. It keeps everything clean and transparent.
So, we figured out how to find the errors and how to fix them. But why do we go through all this trouble? Well, that brings us to the moral of our story. Why accuracy is just so incredibly important.
The payoff for all this detective work is huge. I mean, accurate books mean you actually know your true profit or loss. They give you reliable numbers so you can make smart business decisions. And, maybe most importantly, they build trust. Whether you're dealing with investors, the bank, or the tax office, a clean set of books shows integrity and gives everyone a true and fair view of your company's actual financial health.
And there you have it. We've cracked the case of the unbalanced books, going from that moment of panic to total clarity. We've profiled the suspects, we've followed the clues, and we've mastered the art of rectification. So the only question left is, now that you've got the skills, what financial mysteries are just waiting for you to solve? Happy sleuthing!